Hello everybody, today I'm going to speak about the company called Skyworks Solutions. Ticker is SKWS, and the stock analysis, all the figures are based on the last quarter, Q4 2019, and we are in March 2020, and the current share price is $82. So it's just to have an idea if at this stage if the company is a buy or not. So just to give an idea, Skyworks is developing components at the moment for 4G devices. So for example, on smartphones, IoT device, and the next, let's say, revolution over the next year is going to be the 5G, where at the moment the expected market in 2035 will be around $12.3 trillion. So Skyworks is one of the companies that will benefit from this new wave of technology, and that's why we will look into details just to see at least if the balance sheet is right at the moment and if it can go through the crisis. So let's jump directly into the revenues. So here I give you three different graphs with four different columns, and each column corresponds to quarters. So here are the last value for the last 4 quarters, and this comparison is to give an idea of how the company is evolving, if the characteristics are steady or not. So first, looking into the margins, the gross margins are quite steady overall, around 50%. Just Q2 was a bit different. I don't know what happened. Probably was an issue related with Huawei, I think. And the overall net margin oscillates between 20 and 30%, which is quite healthy. If you look on the second graph, in white, you can see the different revenue over each quarter, which has slightly increased, but not significantly. So this is not at this stage a real growth company, even though it might be like a 10% increase. But we will see that on the next slides. And regarding the OPEX splits, as you can see, they have a constant SG&A ratio of 6%, constant also ratio of research and development around 13%. And based on what happens here, let's say, for example, on the gross margin, this is the net income that will be, let's say, impacted. So that's why it's changing from, let's say, 19 to 29% on the various quarters. But overall, this is a really nice net margin, and at least they can make, let's say, they have some room in case of a gross margin loss, temporary loss. They can still make money with this type of net margin. Now let's look into the balance sheet. So the concept here, I take every item of the balance sheet, and I implement on each of the items the 4 values over the last 4 quarters. So if you see the first one in dark grays will be Q1, then after you have Q2, Q3, and the last one in color is Q4. This is to give an overall idea of what is evolving over the last year in terms of debt. So as you can see here, the long-term liability just increased slightly from, let's say, $400 to $500 million. So it's still decent. They acquired some properties here, so that's why the last, let's say, tick is a bit higher. But overall, also what is interesting to see is what happens on the liquidities. So cash and equivalents, short-term investment, receivables, and also total inventory. As you can see, the inventory hasn't changed too much. The cash and equivalent has increased a little bit, but overall it's really steady. What is interesting here to see on this graph is to see the ratio of debt compared to the total asset value. And as you can see, the short-term asset, which is all the liquidity, can easily reimburse the short-term debt and the long-term debt. So it means that the company is really in good shape to, let's say, enter the crisis in case they start having revenue loss and start having to, let's say, increase debt or whatever. Now let's go to the cash flow statement. So the same here, I have 2 graphs. The first graph here is summarizing the last 4 quarters, and the values that you can see here are cumulative. Okay, so it means that This is 6 months, after 9 months, and after 12 months. And then here it resets and then go back to 3. So here it's cumulative from the first 3, and then after it's the new value here at 398. So I split this cash flow into different colors. Operating cash flow, which is the one that we are interested in, the one that making the money. The investment, which is usually the capex or acquisitions. And after the financing, which is usually the dividend payments and also the buyback. So as you can see, they have a very, very strong cash flow generation over the last 4 years, which is really, really steady. That is excellent. But also we can see a lot of financing items that are quite significant in this cash flow statement. The reason why they have such big numbers into this financing box is that they provide dividend, and also they did a lot of buyback, shares buyback. If you want to know approximately, I went into details, but 1/3 of these financing activities is for the dividend, and 2/3 of it are for the shares buyback. Then you have the investing part, which let's say is still regarding the capex and acquisitions. But overall, what is interesting to see is the net change in cash flow over the year. So if you do the sum of these 3 components, you get the total, which is overall over the last 4 years quite steady. So because the company is generating a lot of cash, they can afford to pay dividend around less than 2%, plus make some buyback. And that's what we were going to see here on the next slide regarding the numbers of shares. So this is the same here on the quarterly basis here and here on the yearly basis. So from 2016 until today, they buy back share a lot, and then they reduce the numbers of shares by 8%, which is quite significant. Now this configuration is good when you don't have any crisis, when you have a strong cash flow, and then when you don't need to invest so much. The company now will face the crisis as every other company, and also we'll have to invest probably even more into the 5G technology over the next years. So we might, the company might be able to, let's say, avoid to buy back and then save some cash in case the operating cash flow is reduced. Okay, so now let's go to the summary. This is the identity card of Skyworks. And what I like to see here is to have an overall view just in one page of how the company is behaving. So what is interesting to see is what is the return of the company and how do we do it? Not through the PE ratio, which is the usual value, but through the free cash flow divided by the enterprise value. This is a way to a better way to identify how much real free cash flow the company is generating. So the enterprise value actually is $12 billion here. The earnings over the last 4 quarters was 826 million, which I remove. No, sorry, depreciation actually is already part of the income statement, so the earnings are already considering the depreciation. That's why I consider the free cash flow as an earning. And then let's say the yield, the return of the shares will be around 6.6% for the last 4 quarters. If I just consider last quarter, the return will be even higher at 8.2%. Another metric that I like to use to let's say have an idea or to gauge a company is if we remove the research and development investment, how much the company would yield. And actually you can see that the company is yielding more than 10%, so 11.6% based on the last quarter. So these are really good values, even though, let's say the company is not growing, is not a growth company. Regarding the metrics, the value metrics, we have an EV to sales of less than 4, which is quite decent for such a company with a 50% gross margin. so it's quite good. The price to cash is a bit low. I mean, it's a bit high. Less than 10 is better. Um, but they really play with this dividend payment and buyback, shares buyback, so they don't really accumulate cash. They prefer to invest into dividend and buyback. So this is not the best for, let's say, it's good for investor, but not so good for the company, which should invest more into research and development for like future growth. But this is how it is. Okay, so the dividend is 1.9%, and last year the shares numbers reduced by 1%. What I can see here also is regarding the long-term debt compared to the earnings is less than 1 year of earning. So it means that if the company needs to reimburse the long-term debt, it can do it in less than a year. So which is really, really good. Now related to different margins, as I said, very healthy, the net margin between 25 and 30%. The operating revenue per employee is in the average between $150,000 and $200,000 per year per employee. And the cash at the moment per employee is not so good. 132 is not too much, but as I mentioned, they can always free up some cash if needed, if they just stop the buyback or cut a little bit the dividend. The last point I like to look at is the revenue growth. Over the last 3 years, it was like quite steady, only plus 3%, but the OPEX actually increased by 22%. So we don't classify this company as a growth stock, but for the reasons I was mentioning on the 5G, it might come back to this stage of a growth stock. So that's what is interesting. It has actually a very good yield return, a very low debt, and also a potential promising revenue growth for the next years. And that's it for the ID card. Now I tried to make a quick comparison with Qualcomm because usually everybody is mentioning Qualcomm for the 5G, let's say, revolution, and I really like to understand which company would be the best bet between Skyworks and Qualcomm. So this is why I made these comparison tables. Same principle, the two ID cards that I try to compare, and make basically let's say a contest between the two companies based on the free cash flow, so the yield return without R&D, the revenue growth, the net margin, the leverage percentage, the operating revenue per employee, the long-term debt per yearly earning, the retained earning divided by the market cap, and also the cash per employee. And I compare them, and basically it gives me like an idea of who's the winner, who's the loser. And as you can see here, Skyworks is winning easily against Qualcomm. The thing that I don't really like into Qualcomm is their debt that is already very high. They have edge debt per earning of 6.0, which is quite high. They didn't have much revenue growth over the last 3 years. It almost decreased by 20%. They have decent amount of cash, but this is really what I don't like is that they already have a lot of debt, and in case they need to increase their capex for the next year's deployment of 5G, that might be a very limiting factor. Okay, so that's why for me Qualcomm is Skyworks is a winner on this contest. Just for a summary, just from the pros is like 5G IoT is coming soon, so this stock, which is not a growth stock at the moment, might go back to this high growth revenue ramp. The balance sheet is really good, really sound, no much debt, and still very good yield. And also they can easily create a cash reserves in case the company stop buying back shares, and this is probably what they will be doing during the crisis. So it gives them a lot of let's say room for adaptation during this difficulty are coming. So I think that's it. I go back just to the ID card if you want to have a last look. If you have any comments or questions that maybe I missed anything, or if you want to look at a different company for my next videos, just let me know in the comments, and then I will try to answer. Thank you very much, and see you soon. Bye bye.